The FDIC came out with its quarterly report, and it once again is showing us how banks are struggling. There's reportedly $517 billion in unrealized losses that the banks have on the books, which is another $39 billion from the previous quarter. In this video, we are going to talk about how that affects you and if it's time to start stashing your money in places other than the bank. So let's break it down and take a look at this FDIC report. Unrealized losses on unavailable for sale and held for maturity securities increased by $39 billion to $517 billion in the first quarter. Higher unrealized losses on residential mortgage-backed securities resulted from higher mortgage rates in the first quarter and drove the overall increase. This is the 9th quarter of unusually high unrealized losses since the Federal Reserve began raising interest rates in the first quarter of 2022. First, let's take a look at why they're having these losses on residential mortgage-backed securities. I think we need to understand first that there are two separate things going on here at the banks that are cause for concern. There is a lot of talk about commercial real estate, and I think a lot of people attribute these unrealized losses somehow to commercial real estate. But what they are in fact talking about is bonds, collateralized mortgage bonds. And I found this really good article that explains exactly how these things came about. So it says here, in the near zero interest rate environment of 2020 and 2021, banks were forced to take an interest rate risk to avoid negative deposit carrying costs. Even if interest-free deposits are not free to banks, as they must pay deposit insurance premiums on deposit inflows and incur costs providing deposit account services, these costs exceeded any interest banks could earn by keeping deposits at the Fed or by investing in short-term Treasury securities. Sorry, I know it's a mouthful. I just wanted people to actually know where these losses were coming from. So it actually costs money for banks to hold deposits. And the interest rates on short-term securities where banks would normally put their money were so low that the banks couldn't make enough money. They couldn't generate enough money to cover their costs, so they started putting our money, our deposits, in these longer-term, riskier mortgage-backed securities and treasuries. See, banks have to have capital in order to loan out money. They have to have assets on their books. So they put their money in these mortgage-backed securities and they made a modest return. So it didn't require them to raise any additional capital, whether it be from deposits or from somewhere else. And so why is this a problem now? Because when someone, the Fed, decided to raise interest rates, securities the banks were holding went down in value. See, when interest rates increase, investors prefer new bonds with higher interest rates, making the existing bonds with lower rates less attractive. And in order to make their bonds more appealing, they would have to reduce their price and sell at a loss, a big loss. So banks had these securities and they were term securities. So they couldn't just sell them at any time. Certainly not when interest rates were low, or else they would have done so. They had to hold on to them for a certain amount of time, and now they are available for sale. But there's a big problem. Interest rates are up and they've lost value. Nobody wants to buy these lower interest bonds. They can make more return purchasing the higher interest bonds, and the main driver for this is, you guessed it, the Fed's interest rates. Simply put, the longer the Fed keeps interest rates high, the more likely it is that we fall into a recession if we're not already in one, or something more catastrophic happens with these banks. Now on to the commercial loan part of this report, which is my favorite part because I am a real estate investor. That's what I do for a living. The increase in non-current loan balances continued among non-owner occupied CRE loans, driven by office loans at the largest banks. Those with assets greater than $250 billion. The next tier of banks, those with total assets of between $10 billion and $250 billion in assets, is also showing some stress in non-owner occupied CRE loans. Weak demand for office space is softening property values, and higher interest rates are affecting the credit quality and refinancing ability of office and other types of CRE loans. As a result, the non-current rate for non-owner occupied CRE loans is now at its highest level since fourth quarter 2013. Wow. Again, this all goes back to the Fed's funds rate. Owners are unable to refinance their properties or even sell their properties because values have dwindled so much. If interest rates were lower, a lot of these properties would be able to refinance out or be purchased by a new investor. The problem with refinancing is current owners have a 4% interest rate, and now they're going to be going to an 8% interest rate. And not only is their payment going to be higher, but oh wait, they're also facing that little problem of actually not having any income in the first place. Why? Because no one's working in the office anymore. However, I do believe that most banks are going to work with the owners as long as they can and extend these loans. But the longer that the Fed holds interest rates as high as they are, it's more likely that this is going to become a real problem. And you're already starting to see cracks in the system. Every couple of weeks or so, you'll see some large office space in some downtown city that is selling for 40, 50, 60% off. And the reason that they're selling is because of the reasons that I just mentioned. Remember, commercial real estate is only worth as much as the income it brings in almost 90% of cases. Unless it's some downtown New York City flagship building, it might garner a little more value, but all in all, commercial real estate is going to be valued on the income that it brings in. And if it don't make dollars, it don't make sense. So this article also mentions credit card write-downs at the highest level that they've been since 2011, which no surprises there. Inflation is through the roof, right? With things being more expensive, people are running up their credit cards and kicking the can down the road. They are definitely getting behind, and that's showing in the statistics. And finally, to the part that's been getting this FDIC report a lot of attention, the number of banks on the problem list. The number of banks on the problem bank list, those with a Camel's composite rating of 4 or 5, increased from 52 in the fourth quarter of 2023 to 63 in the first quarter of 2024. The number of problem banks represented 1.4% of total banks, which was well within the normal range for non-crisis periods of 1 to 2% of all banks, which means we are 0.6% away from having a crisis, it seems. So everybody buckle up. And something that totally blew me away was total assets held by problem banks increased from $15.8 billion to $82.1 billion during the quarter. So what I don't understand here is how could their assets increase so much if they were problem banks? I tried to do a bunch of research on this and I couldn't find anything. So if you know how their assets increase so much, I'm genuinely curious to know. To me, it seems if they were problem banks, presumably they're not lending a whole bunch and they're underwater. So how are these assets increasing so much? Again, if you can answer that question for me, please drop it in the comments down below. I'd be curious to find out. But really, what we want to know is this enough cause for concern for you to take your money out of the bank and resort to some drastic measures? How bad is the situation compared to 2008? Well, there's a couple charts that I can show you that won't make you feel good, but I'm going to go ahead and show you anyways. These were the total bank failures in 2008. And look how closely those three banks from 2023 alone almost equal the same scale as the 2008 crash. Pretty crazy, isn't it? And the bank losses on securities don't even compare to 2008. I don't know why there were no unrealized losses back then. Might have been a regulatory change. But regardless, we have to think about this realistically. The federal government really can't let any bank fail. They can't let your deposits not get paid. Now, if you have over $250,000 in a bank, it might be worth moving anything over that amount into another federally insured bank. I mean, think about it. If they were to let a bank fail and let people lose deposits, then that would just cause every person in the United States to pull their money from the banking system, which in turn would cause a giant crisis. So realistically, the Fed isn't going to let anything happen to your money. They're going to bail out the banks, and they're going to bail out your deposits and my deposits if worse comes to worse. But again, it's completely up to you whether you want to leave your money in the bank. Obviously, there are some things going on that are cause for concern. If it was me, and this is what I do, I just put my money in the biggest banks. Put them in banks that are too big to fail, if you will. That's probably the best amount of security you're going to get. So anyways, if you made it this far into the video, please let me know what you think in the comments down below. I'm curious what you think about this whole situation. Do you think it's all going to go up in flames, or do you think we are in the greatest economy known to man? Let me know what you think in the comments down below. And as always, thanks for watching. Please click that like button, hit the subscribe button, and I will see you on the next one.